Mark Twain had a saying, history doesn't repeat itself, but it often rhymes. And let me tell you, you may not make an ounce in this next dead cat bounce. I'm not a poet. Basically, we may be back where we started when I made a video a few months ago, which I'll go over in a second, but history might be repeating itself here, and let's go over that in a second. So first off, I want to talk about the sentiment cycle. So let's take a look from Game of Trade. It says market goes through cycles. We're now in the stage of discouragement. Most people see a bear market rally given the macro backdrop, yet markets rarely do what everyone expects them to do. On the left here, we have returning confidence, and basically we could say that over here, there's an overt warning, and then there's a subtle warning also here, and then this is disbelief. So basically, let's say last year, 2021, this is essentially probably what was happening. People weren't thinking that, okay, the market's overvalued, even though it's at historically high levels, and it should probably have not been anywhere near where it was. And of course, obviously, there were tech companies that were making essentially no cash flows, that were trading at huge multiples of, let's say, revenue that probably shouldn't have been there. And then this is enthusiasm, of course, right? So you buy the dip. We heard that so many times before. Last year, 2020, 2021, buy the dip, buy the dip, buy the dip. And then you have enthusiasm when it actually works out, right? Because it worked out many times before. And then today, it's not working, right? And you have this decline. And essentially, there's panic. You had anxiety, which we're already in, obviously. In 2022, we've had anxiety. Panic, I don't know. I don't know if I'd say we've had panic, but I would say a lot of people would say we probably have had panic. I don't necessarily think we have. I don't think there's been much panic right now, but he says we're down here, or he or she, Game of Trade, says we're down here in discouragement, right? And that's what this person thinks that we are in. Next would be there's the wall of worry, and then you hit anxiety, where you try to get back up to these levels. And then you have the denial phase, which is on the other side of this, right? So we have to think about this. Okay, it starts off with you buy the dip, you're in disbelief, right? You're in disbelief that the market can actually fall, and then it finally does, right? And that's when all of a sudden your disbelief is essentially turned into belief, and then you have this psychological thing happen where you're like, I don't want to be tricked again. I don't want this to happen. So you stay in this phase of worrying and aversion and anxiety and denial, and then you stay in this denial phase when the market starts ripping higher. And so what you have to do is you either have to stay invested through the whole thing, or you have to be really good at understanding this whole psychological sentiment cycle, and then not, hurting yourself during it. And that's really hard. And so that's why I just kind of try to stay invested through this whole thing and continue. All this being said, let's talk about the bear market rally, because according to Game of Trades, I think that he or she thinks that that's probably not this next rally that's happening. That's not a bear market rally. I'm not sure, I'm not 100% sure, but that's what it seems like the tweet's saying. So this is from Charlie Bolello. The bear market rally we saw off of the June low was a big one. 17% up on closing basis, but certainly not unprecedented. Longer bears like 2007 to 2009 and 2000 to 2002 both had 20% snapback rallies where it looked like the worst was over, only to be followed by lower lows. And here he's showing some different areas. So we have 2020 here. This is where we are now, where we had positive 6.2%, positive 11.2%. Then we had this negative, we're looking at negative 24.3%, positive 17.5%, right? And so there's these rallies, and then we are having declines still. And then the general trend is down because these are bear market rallies. They're not essentially rallying us up out of the old lows, and we have not hit the highs, of course, yet. So we're continuing to make lower lows, even though we think that maybe it's over every time we get this rally. And this similar thing happened back in 2007 to 2009, and similar thing happened in bear market rallies 2000 2002. It actually is a bear market rally. So a bear market rally refers to a sharp short-term rebound in share prices amid a longer-term bear market decline. Bear market rallies are treacherous for investors who mistakenly come to believe they mark the end of an extended downturn. Basically, a bear market rally is when you think that the market is done going down, it rallies, and basically you think, okay, this downturn is done, right? This downtrend channel that maybe the market is trading inside, it's over, and now it's going to rally up outside that downtrend channel. Well, basically that doesn't happen, and you get lower lows after that. And so let's show this on a chart. So far right now, we could see two different bear market rallies that we've had. They're pretty big ones for the year 2022. So the first one here we had back in March time period. I'm sorry, it ended in March. And this thing was up 11.5%. So that's how much the rally was. And then, of course, we see after that hit this resistance line, which ends up being this downtrend, this upper downtrend part. And so it hits this downtrend and it continues down further. It bottoms out down here in 36.37 for the S&P 500. We saw another bear market rally, right? Or we could call it a dead cat bounce, bear market rally, whatever you want, up like 18%. So this thing rallies higher and then again, it hits this downtrend line back down. And so this is kind of what we're talking about. We got these bear market rallies that are happening during the year, and we have to like basically make sure that we understand that these are happening, these occur, and how do we get through this basically. Here's a slide from JP Morgan's Guide to the Markets. It says annual returns and intra-year declines, S&P intra-year declines versus calendar year returns. Despite average intra-year drops of 14%, annual returns were positive in 32 of 42 years. So of course, there are years where you're going to be down quite a bit, 14% intra-year, but you're still going to end up having a positive return. Over the long term, of course, right? Only 32 years out of 42 years were there not positive returns. And so we can see here, all of these ones on the top are positive returns, right? So positive returns for the year. And then you have the red part, and the red parts are showing the intra-year drops, right? So start to end of the year, for example, let's go back here to the 80s, start of the year to the end of the year, it's up 26%. But guess what? It was down at 1.17%, right? So it goes down 17% at one point. It rallies all the way back up. By the end of the year, it's up 26%. And what we could see, there's all sorts of different years where it ends up rallying back up and having a positive return. As you can see here, 34% down, 2% up still, right? So that's a huge one, 13% down, 1% up still, right? And we're over here, 25% down, and of course the year's not over yet, so we're still 25% down. We're at the lows right now for the year. But it goes to show that yes, it is possible to kind of pull back from here. And of course, a lot of these years, none of these years, the lowest part of the year was never at the end of the year. As you can see, this red dot is really not touching any of these on the bottom here. So as you can see, definitely possible that we come up from this 25%. We'll see what happens, but who knows? Let's go back to the year 2020, back when the dot-com bubble was going on. And it was a very scary year, let's say, to be investing. So not just year, actually multi-year period. So if we take a look here, let's go back. We're in March 23rd of the year 2000. We made it through Y2K. Everyone thought basically, it was going to be the end of the world in Y2K. All the machines were going to break and God knows what was going to happen. But we made it through. You know what? Yeah, we made it. Great. Now, after that, finally, stock market's up and then it comes down 12%, right? It rallies back up 12%, okay? Goes back down 12, up 12. Okay, great. That rally is back. We're back at all-time highs, and people were thinking that this is it. Market's going to continue going higher, and it did not. As you can see, it continued going further down, and there was multiple bear market rallies. You had up 7% here. You had up 8% here, right? Then you have this from here, from the top all the way down to the bottom here, down 27%. But look at this. You had some rally here where it's up 8%, but it's down again 20% from this point. And these are things that are happening during markets. Like this happens during tough time periods in the stock markets, right? It's not a new thing. It's not like it's not happened before. This is definitely something in history that has happened in the past. And like Mark Twain says, history doesn't always repeat itself, but it often rhymes. And then we have over here, it hits what you think is the low, right? You think the low is over here in March, April of 2001, bear market rally, boom, up 18%. At that point, you're thinking probably, well, this is it. The market's out of its downtrend. We're at lows are in the past, highs are in the future. We're going back up to all-time highs. And what happens? Well, by the time you get to September of 2001, you're down another 26%, right? So this continues happening. It's happened before in the past. As I go forward in time here, look how many times it continues going further down and further down and further down until the point where you're hitting this low down here finally of 776. I mean, that is a long bleeding time. 2002 in October is when it finally hits that bottom, and that's finally it. But look at all these bear market rallies in here. We have a 21% rally. We have a 21% rally. We have a 21% rally. Like, it's crazy that these things were happening back then, and today it can happen again, and it can be a multi-year period, But you have to remember that over this time period, if you were buying on the way down, of course, it was a good thing because over the long term, you ended up making quite a lot of money. Let's zoom out. Let's see how that looks. You were buying this whole way down. You're averaging your cost basis down, 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 lower, lower cost basis, and then it goes up, right? Of course, 2008 rolls around and it does go back down, and that's not good. However, you kept buying, right? You keep buying, always buying, buying, buying. If you're not retired, of course. If you're retired, well, then you have to do other strategies to make sure you have your capital protected. But, if you're young, if you're doing this for a long time, if you're in the market for the next 20, 30 years, you keep buying, you keep investing, and then over time, it just goes up and up and up and up. And here we are. We're all the way up here. You've made tons of money over the time period of this time period, 200 something plus probably percent. And it's been a great time to be investing and to have invested. And it was not a good time to have sold out of the market, stopped investing, because likely what happened is you never really got back in. You just got scared and you thought it was going to be a terrible time. Every time you wanted to go back in, you were pessimistic. There's always a time not to invest. That's what happened. So I always am of the belief that you continue investing as long as you're a net long-term investor. You're going to put more money in over your lifetime than now you have right now. It's always a great time to be investing. And if you're retired, it's different. You have to put things into place to make sure that your capital is protected. How much cash do you have? Do you have bonds? If bonds even are actually a working place to put money to protect capital right now, I'm not even sure. But you need to have things like that, right? You need to have a structure to a portfolio that has some risk management to it as well. Or you're a net buyer of stocks over the long term, and you're just investing over the long term, buying stocks. And over 20, 30 years, you're going to have a lot more money than you do today, no matter what happens in the market, honestly. So that's all I have. I hope this helps. Bear market rallies, they're a real thing. They can really get you. So I have a disclaimer here. If you have not watched all of my videos before, take a look on the end screen. And also, if you're thinking about liking this video or subscribing, I would say choose to subscribe and then like my other videos. That would be a great compromise. So thanks so much and see you next time.